David Roche, strategist at Quantum Strategy, says the latest Fed move on the 50 basis points looks panicky, silly, populist and panicky. I hear what you're saying, David, and I have a lot of sympathy for that view. I guess what I also want to ask you, did it do any harm, though, given the fact that inflation is falling nearer to target?
I think it does harm because it gives two impressions which are false. Number one is that the economy is more fragile than it is. And you've been into the details of the employment report this morning. So the economy is fine, thank you very much, and doesn't need jumbo rate cuts. The second thing it does is to give you the impression that the Fed will cut rates successively to a level which is much lower than it actually will achieve. Fed rates will not go below 3.5%. And the reason for that is the economy is so robust that firms earn enough money without needing a lower interest rate. This is called the famous R star, R asterisk, or whatever you want to call it, which is, of course, one of these phenomena that economists cannot really measure or observe, but they nevertheless go on about it. So the point I'm making is the US economy, in contrast to Europe or Japan, is a very dynamic and robust economy. And it does not need rock bottom interest rates like the European economy does. By cutting hard in the beginning, you give the impression that there will be more cuts, more jumbo cuts of 50%. And therefore, you will reach a level of interest rates which is way below where you're going, which will result in market instability when the market wakes up to that fact. That's the damage you do.
David, what do you make of some of the weaker signals we did get right under the hood? I mean, you had to really delve for them. ING point out that full-time employment in the US has been negative year on year for 8 consecutive months, and that if you look at the part-time component wasn't great. In fact, some of the low-quality jobs being created were the really dominant factor here. What do you make of some of those weaker signals?
Well, of course, I never criticize the work of other people doing the same thing as myself, because I always assume they're much better. But if I look at the figures, I find very few signs of real weakness. Looking out, it seems to me that what has happened in the jobs market is, of course, it has weakened. It has to have weakened. Otherwise, you couldn't reduce interest rates as a central banker. But if you look where the weakness has occurred, it has occurred in new hires, not in layoffs. So essentially, people are not losing their jobs, they're not changing their jobs, and it is more difficult to get a new job. Essentially, what that actually means is the labor market has adjusted, but it has adjusted in a way which does not cause recessions. Recessions are caused by people getting laid off, and that is not happening. Therefore, you do not need jumbo rate cuts, because all that is happening is the market for labor is adjusting in the manner that it has to adjust if you're going to be cutting interest rates in the first place.